What's up, everyone? Happy Monday. Welcome back if you have caught any of our recent videos. This is the fifth or sixth video that we've dropped, and what my goal will be is to do a new video every Monday at 6:30. This video is on the cost of home ownership. A lot of the aspects of it are your standard things, that the numbers you get from your lender and from your real estate agent. There's a lot of hidden costs involved in that, and a lot of adjustments to the standard costs even a year into it. So what I want to do is make sure that you have all the information, not just a portion of it, to know that in 6 months, 12 months, 2 to 3 years, you guys are still comfortable and able to afford your home, and the numbers haven't gone up by 15, 20, 30%, which can go from making something very affordable to unaffordable. My whole goal, and I always say it in almost every video, is I want you guys to be house rich, not house poor. And one of the hardest things that can happen, one of the largest reasons on why that really happens, is because somebody may calculate their numbers as year one, day one, these are my move-in costs. Sure, they are. But if you're not accounting for other things, whether that's landscaping, whether that's pool, whether that's just regular maintenance to the AC, to the roof, to paint, to everything else, potential HOA dues, the increases on things like that, there's so many aspects, and I'll get into all that in this video. But if you're not calculating that from the beginning, it can make something go from very affordable to very unaffordable quickly. And that's the last thing that I want to happen to you guys. So without going any more into little details, let's jump right into it. The first one is what everyone immediately thinks of, is your monthly cost of what the lender is giving you, what the lender is telling you. And that number is basically four things. It is your principal, your interest, your insurance, and your taxes. So again, if you were to buy a house cash, you wouldn't be required to have insurance. You're required to have insurance because you have a partnership with a lender, a mortgage company, and that bank is requiring you to have insurance on your property. You can shop around who insures it, but you need to have insurance. Taxes are something, this is the big one, and I did another video on it, but it's one of the big things that I want you to pay attention to, because just because your taxes are $2,000 right now on the property does not mean next year they're not going to be 10 or 12,000. Even if it's 6, it can very quickly change your affordability. So it's just one of the main things. Two of the things that really won't change a whole lot are your interest. You're going to lock that in, and your principal. So unless you do a big chunk payment to knock down what your principal balance is, your 15 or your 30-year loan, those two are going to stay stagnant. They're going to stay, which is good. There, unless you get a fixed, like an ARM and a 7-year loan, most people do a 30-year fixed rate. 30-year fixed rate means that your principal and your interest payment are going to stay the same. The other two are the two that could potentially change. And I did do a whole video on this earlier. I will link it down below. But that is really in regards to how your taxes can adjust after you get a adjustment and proration from somebody who previously maybe homesteaded the home, and they had a lot of savings that they're now giving up, and you're now taking over on the new assessed value. That can be a big change. And insurance. Insurance is becoming, they've redone flood zoning, which is going to be something that I will come through and do later, but there'll be a second video on that regarding how they rezone the area and how homes that potentially weren't in flood zones before are now in flood zones. And flood insurance has potentially gone up. Some homes that were paying $1,200 and $1,500 for the South Florida people, they might now be paying $1,800 to $2,000, $2,500 for the year. Again, sometimes it's not a lot if it's $50 or $100 a month, but it all adds up. And I think that's the biggest thing, is sometimes it's $50 here, $100 there, and all of a sudden you're $1,000 more a month, $2,000 more a month. And that really is what adjusts the affordability, and again, can make you go from being house rich to house poor. So the big one is your monthly mortgage payment, but that's not the big thing. So let's, for ease, say that your monthly mortgage payment is $2,000 a month. Okay, that's an affordable number, even if maybe next month it goes up to 21, next year it goes up to 21 or 22 if your taxes get slightly readjusted. Hopefully, if you can afford one, you can just afford the other. The problem is a lot of people aren't now going through and saying, like, oh, my monthly right now, what I can afford is this. But they're not accounting for your water, your sewer, your trash, your electric, your utilities, whatever that may be, your cable. A lot of people stream, so you don't have cable now, but you're still going to need internet for that. And all those add up, and they're getting slightly more expensive every month and every year. So it's one of those things where you look at electric and it's $100, $200, $300 a month. You look at your water, sewer, trash, it could easily be $100+ a month. You look at your internet, cable stream, and everything else, $100, $200 a month. So now you have another $500 that you're adding on to your $2,000, and now you're at 25 or 26. And then the big one is, and it's not as, if you're in more of a condo or townhouse, you're going to have your potential HOA numbers, which can change as these buildings are getting older. You want to see what they have reserves for. It's a big question, and I'll do another whole video on how that works. But in short, you want to make sure the building is on a monthly basis collecting money for when they need to repaint, when they need to re-roof, whatever other main things they're looking at coming on. There's normally a plan of they repaint every 7 years, the roofs every 25 or 30. You just want to make sure the money's there, otherwise you'll get an assessment or you're going to get a bump in your HOA number on a monthly basis. Either one of those is going to, again, make it your monthly number and affordability really struggle and change potentially. If you're in a single family home, you still could be in a gated community. You still could have an HOA. But even if you don't have an HOA, now there's a whole other set of aspects, whether that's you dealing with the roof, you dealing with plumbing, you dealing with painting and landscaping and annual and monthly yard work, you dealing with, if you have a pool, either the chemicals. At my last house, I took care of my pool and it was still $50 a month in chemicals. If you have somebody come out even every other week or once a week just to skim it and do the chemicals, you're paying $100 to $150 a month. Your lawn's another $100+ a month. If you have if you have bushes and everything else, you could be $200-$300 a month. So very quickly, this is another $500 a month. You have an AC in the house that you probably need a maintenance plan for every 6 months, which is going to cost you another $200 to $300. They're all little things. It's only $20 a month, but as you start adding these up, your $2,000 a month is very quickly $3,000+. And so it's just something that I really, I know I just kind of keep harping on it, but I want to make sure that your affordability doesn't change. I have so many horror stories, and I mention this almost every time, of past clients or people that I've talked to who are clients now who have worked with other agents really, and you hear these stories of how they were kind of misled or only given the information that was the positive side and not shown the whole picture. And that bothers me so much. And I know so many people, this is why so many people look at you like real estate agents almost like a used car salesman or kind of sleazy and slimy, because so many people think that agents in general are all the same. We're all out for commission and we don't really care about what the result is. I mean, me, for example, I work in a very small town. I mean, it's not small, but it is. All the agents know each other. Your clients all know family, everything else. You can very easily say one or two things or do one or two things incorrectly and be blackballed or be kind of pushed out of the community. And that's how it should be. I mean, if you're not doing the right thing, you shouldn't just continue to fleece people and get away with it. But it happens so often. It's really unfortunate. So if there's anything that you've had in the past, please drop a comment down below. If it's been a problem, if it's been something that maybe you weren't aware of or you didn't understand or you want a little more information of, drop a comment down below. I am always happy to try and provide more value in that. I'm looking for more video topics. I have another 5 or 6 weeks worth, but after that, I'm always looking for other ways I can add value and maybe answer a question that's an unknown to you. Because again, every single case and every home purchase, home sale, everything is different. And so what I've experienced could be very different from what you've experienced, whether that's because we're in different markets and areas, or it's just a different case basis. But again, I don't want anyone to feel like they're being left in the dark at any point in the transaction process. You don't have to be using me, but if you have questions and you feel like I can shed some light and open some things up, I'd love to. I have a lot of friends out of state that call me all the time and say, hey, Reed, will you look at this contract? I'm doing this. It's a little different. What are your thoughts on this? Sometimes it's just another point of view. It's just someone else giving you their 2 cents and giving you their professional opinion that maybe you take what you were already working with and adjust slightly, and it now ends up being a better result for you. So it never hurts to reach out and ask questions. I'm always happy to help anytime I can. But again, the big thing here is when you are looking at your home, please look at the whole picture. Don't just look at the email and the affordability that your lender has given you. Because unfortunately, last thing I will say is a lot of times, these lenders are out looking for themselves as well. Not all of them, but a lot of them are. And they're going to push your DTI all the way to 50, 52, 55%. And they can pull out a lot of these side costs. So now all of a sudden, you're bringing in $4,000 a month and you're spending $2,100 on your mortgage and another 5 or 6, you could be $3,000 or $4,000. You could really be at a 70 or 75% DTI just on your mortgage, and if you have other bills. So I just want you to be very careful that that number doesn't creep up and your excitement for getting into a specific home or seeing it outweighs the practicality of it. Of in 6 months, is that excitement going to be gone, and now you're really struggling to pay these bills? And it goes from excitement to fear and depression, a lot of issues. So I don't want that for anyone. So again, I'm out here to help. Please, if this has helped you, I really appreciate whether you share it, comment, send it to other friends if you think someone else might be helped with this. Following along, I really do appreciate the support. And as you guys probably know, it really does go a long way for the channel and getting it out there to more people. So thank you very much. Happy Monday, and I'll see you again next week. Thanks, guys. Have a good one.